So you think you know how the Federal Reserve creates money, right? Well, what if I told you there was a kind of secret money printer, operating right out in the open, pumping billions of dollars into the financial system every single month? Okay, let's get into this, because that is exactly what we're going to break down today.
To really wrap our heads around what's going on, we first have to talk about the Fed's vacuum cleaner. And yeah, I know, that sounds pretty weird, but stick with me here, because this one simple analogy is the key to everything. See, it's got two settings, suck and blow. And for quite a while, it was set firmly to suck.
All right, so let's start with that suck setting. To get why the Fed had to suddenly flip the switch, we first need to understand what happens when it's actively trying to pull money out of the economy.
Now, the official fancy term for this suck setting is quantitative tightening, or just QT. The easiest way to think about it is it's the exact reverse of what the Fed did after the 2008 financial crisis. Remember that? Back then, they bought up trillions in bonds to pump money into the system. Well, with QT, the Fed just lets those bonds run out and pulls that cash right back, shrinking its own balance sheet and, you guessed it, shrinking the amount of money that's available to banks.
But here's the catch. What happens when you use a vacuum cleaner that's maybe a little too powerful? Well, the system starts to strain, and pretty soon, some really critical parts of the financial plumbing begin to dry up completely.
And this kicks off a very clear chain reaction. First, the Fed's balance sheet shrinks. That directly pulls cash reserves out of the entire banking system. And when banks have less cash on hand, they get nervous, they get hesitant to lend, not just to you and me, but even to each other. And this is what leads to the very real risk of a credit shock, which is basically a sudden freeze-up where money just stops moving.
So the crucial point here is this. The system was facing a really dangerous lack of liquidity. And liquidity is just a fancy way of saying available cash. You know, the grease that keeps the economic gears turning. Without it, the whole system can just grind to a halt. And the Fed started seeing some serious warning signs that this was about to happen.
And that forced their hand. They had to do something pretty dramatic. It was time to reach over and flip that big switch on the vacuum cleaner, all the way from suck over to blow.
So, how does this blower setting actually work? Well, think of it as having two different nozzles. The first one is kind of like a spray bottle. It gives a temporary, targeted mist of cash to handle immediate shortages. In Fed speak, this is Tommo, or temporary open market operations. The second nozzle is more like a sprinkler system, a steady, long-term flow of money designed to keep the whole lawn green. That's Pomo, or permanent open market operations. They're different tools for sure, but the goal is exactly the same. Push cash back into the banks.
So just how much power does this new blower setting have? Well, let me tell you, the Fed didn't just turn on a little fan here. They basically turned on a fire hose.
Just look at this number, $60 billion per month. That's how much cash the Fed started blasting back into the system. It's an absolutely staggering amount of money, and it was designed to solve that liquidity problem, and solve it fast. Now, officially, the Fed's goals were pretty straightforward and, defensive. They said the whole purpose was just to support bank liquidity and prevent that nasty credit shock we talked about. They were very clear that this was not another round of quantitative easing, or QE. Nope, just a technical adjustment to keep the financial plumbing working.
But whenever you inject this much money into a system, there are always going to be unintended consequences. So the big question is the Fed just fixing the plumbing, or is it accidentally inflating the next big bubble?
And this gets us right to the heart of the huge debate going on right now. That $60 billion a month has to go somewhere, doesn't it? When money is this cheap and this plentiful, it tends to hunt for high-growth, high-risk places to live. And a lot of analysts are arguing that this fire hose of cash is what's propping up asset prices across the board and might just be a major fuel source for the AI bubble we've all been watching.
At the end of the day, it really boils down to this tension right here. Is the Fed the hero, providing necessary support to stop a financial crisis in its tracks? Or are they the villain, creating a massive artificial bubble that's just destined to pop? Honestly, the answer really depends on who you ask.
And that leaves all of us with the huge question moving forward. Was this switch to blow just a temporary fix for a one-time technical problem? Or have these massive cash injections become a permanent feature of our economy, something the market now needs just to stay afloat? The answer to that is going to shape our financial world for years to come.